In just a few decades, China has managed to achieve one of the most outstanding economic feats in the history of the world. Through having the largest population in the world, the country has persevered to transform from a backward agricultural-based society into a superpower and a force to be reckoned with. Napoleon is said to have predicted that when China will wake from its slumber, it would astonish the world. China has climbed from weakness and backwardness to a position of global leadership in just under 3 decades. Since 1990, China's GDP and per capita income have grown at a compounded annual growth rate of a lightning 13% and 12% respectively. As the country expanded its horizons to trade and adapt the ideals of a free market, it has managed to pull 1 billion people out of poverty and set an example for other developing nations and the rest of the world. Initially, the rapid rise of the Chinese was fueled by maintaining good foreign relations and a diversified fiscal policy, because of which exports flourished. The government targeted industries like transportation, housing, large and medium-scale manufacturing, and finance to inject stimulus into the economy. The Asian underdog state has now reached a stature where it stares the United States of America straight in the eyes fearlessly. Now let's take a moment to digest the fact that this is a country that has become the second largest economy in the world in about 30 years. The prospect of transcendent Chinese wealth and power, coupled with America's devaluation of its own political and economic prestige, has led to mounting speculation about China's emergence as a global hegemon to rival and perhaps in time even surpass the United States. However, today, what we are witnessing in China is pure horror. To reach giddy heights of success, one requires a great story and minions to follow orders, both of which China seems to have in plenty. 30 years is an impressive time frame to have achieved so much, but the truth is that the whole country is built on the weak shoulders of debt and lies. Now, I've tried my best not to be cynical and doubtful about the situation, but the way things are unfolding in their economy today is truly a nightmare. Today, we will uncover how deep in the muck China really is concerning debt, and believe me, this goes so much deeper than just Evergrande. We're going to look into why debt, and especially the debt that China has in abundance, is so dangerous, which industries in China are overburdened and destined to fall, and what happens when this house of cards finally collapses. But before I jump into today's video, I want to thank the Daily Upside for partnering with my channel. The Daily Upside is a free business and finance newsletter I actually use every morning to help get an edge on the latest business news. Check out the link in my bio to subscribe for free, and also make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then make sure to check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. Now, a debt crisis in a country can and frequently does transmit economic misery to other countries, whether in the private or public sector. A tightening of financial circumstances, such as a rise in interest rates, a slowdown in trade and economic growth, or just a sharp drop in confidence, might cause this. This is especially true if the crisis country is large and intertwined with the global economy. Overburdening of debt can result in significant losses for banks, both local and international, thereby jeopardizing financial system stability in both the crisis-affected countries and places overseas. This could stifle economic growth and wreak havoc on global financial markets. If a country's debt crisis is serious enough, it, sure enough, is capable of causing a rapid economic recession at home and consequently dragging down global growth. The financial health of countries is often tracked by a metric called the debt to GDP ratio, which is simply the gross debt of the country, which includes private and public amounts, divided by the GDP. According to the IMF, a healthy debt to GDP ratio for a country should be at a ballpark figure of somewhere in the range of 60%. Well, guess what? At the end of 2020, China's debt to GDP ratio was recorded at a jaw-dropping 270%. China's outstanding foreign debt, including US dollar debt, reached $2.4 trillion in 2020. Just the external debt of China is equivalent to India's GDP on a whole. State-owned or state-controlled financial institutions own the majority of China's local government debt. Local governments in China have relied on off-balance sheet borrowing through local government financial vehicles for decades known as LGFVs. Looking at the state of the country, it goes as no surprise that many of these loans go unrecorded, and there is practically no transparency about how the money is spent. Standard & Poor's predicted such hidden loans to be between 30 and 40 trillion yuan in 2018, which is about $4.5 trillion. Domestic institutional investors, such as commercial banks, are the most common holders of Chinese debt, followed by policy banks, which are state-owned banks whose investment and lending activities support government programs, including issuing bonds. After the United States, China now has the second largest bond market in the world as well. So what is the problem at hand? Well, amid the epidemic, a massive tsunami of debt has engulfed the planet, with borrowings spiraling out of control. The world is staring at a massive debt mountain totaling $226 trillion. It is the world's largest increase we've ever seen since the Second World War, and at the center of it all lies China. Every now and then, a corporation gets so large and messy that governments are concerned about the consequences for the rest of the economy if it all fails. Evergrande, a behemoth real estate developer in China, is that company. They have the dubious distinction of being the world's most indebted property developer, and the company has been on life support for months now. Since August 2021, it now appears to be in the midst of Asia's largest corporate restructuring. Now, Evergrande is a massive real estate conglomerate with millions of residences in China. The company owes more than $300 billion in debt, has hundreds of incomplete residential complexes, and is being sued by disgruntled suppliers who have shut down construction sites and customers who aren't getting what they paid for. The situation deteriorated to the point that the company paid its past due obligations with incomplete properties and asked employees to lend it money under threats of firing if they didn't abide. The bonds issued by Evergrande to raise these cash piles of debt are junk, which surprisingly enough is actually an official term to describe the stability of the debt, and it means exactly what it sounds like it does. What happens next might have ramifications for China's economy, affecting home buyers, over 3.8 million jobs directly and millions more indirectly. Now, in a previous video, I explained how, because of limited investment avenues in the country, people for decades now have put their faith in the real estate market. The entire industry runs on a system of who the greater fool is. Institutions in China, with the support of the government, continue to build ghost cities for as far as the eye can see. Now, these ghost cities are nothing but hollow cement shells in the name of housing projects and are sold to citizens under the guise of being a lucrative investment opportunity. The authoritarian CCP is extremely resourceful when it comes to manipulating the country with fake news and awful humanitarian laws. Nobody knows how long this market will last, but by God, it is scary to imagine the scale of the uprising China could witness when all these real estate time bombs clock out at the same time. But before I go any further, I want to thank The Daily Upside for partnering with me on this video. The Daily Upside is a free business and investing newsletter that over 200,000 people subscribe to, myself included. The Daily Upside was founded by a team of former investment bankers, scholars and journalists with the intention to provide color and clarity to help investors sift through the noise of the financial news space. Instead of pushing clickbait financial headlines and biased coverage that traditional outlets have gotten used to, The Daily Upside provides actionable insights and clarity on the stories shaping the business world. Every weekday, they deliver a morning brief followed by more detailed stories that are shaping the world. I started reading The Daily Upside 3 or 4 months ago, and now it has become the first thing I read when I wake up in the morning. It's about a 5-minute read that isn't afraid to dive into the hot topics and give real high-level, unbiased analysis with the occasional dose of wit to keep things interesting. Recently, I've been enjoying their weekend edition newsletter that goes a little bit deeper into niche industries. This past week, they had a really interesting piece on the growth of the buy now, pay later industry seen with companies like Klarna. As someone who looks to stay on top of news to help create videos like this, I can't recommend The Daily Upside enough. Click the link in my bio and join the 200,000 other people that read The Daily Upside every morning. It's free, and if you don't love it, you can always unsubscribe. Now, believe me, I wish I could conclude this video right here and say that the issue stops at real estate only. However, umpteen different industries in China are plagued with unsustainable debt, corruption, and red tapeism. Sure, Evergrande's $300 billion may seem like a mega sum, but this is just the tip of the iceberg. The problem exists in the country's most prized and successful projects as well, the railways. Now, at the beginning of the 21st century, China had no high-speed railways. Trains plodded along slowly and often inconveniently across this huge country with low average speeds, making journeys like Shanghai to Beijing a test of endurance. Today, the picture is radically different. The world's most populated country possesses the world's largest and busiest networks of high-speed rail, and it's not even close. All of the country's major megacity clusters are connected by 38,000 kilometers of lines. That's over 23,000 miles for the Americans out there. Now, all of this has been built in about 14 years since 2008. The high-speed rail project came out as a fiscal stimulus project by the Chinese government, spurred on by the 2008 global financial crisis. Chinese trade intensity was suffering, which isn't too surprising in hindsight. Their customers were hurting, their imports and exports were starting to drop at worrying rates. The government decided to sanction the project to put tens of millions of people back to work, and today, the livelihood of tens of millions of people is directly reliant on railways in China. After 12 years, some of these lines have seen spectacular successes, but there are plenty more which have proved to be a little bit more than useless money pits. Nonetheless, at the behest of the government, they continue to be built with the help of insane leverage and dying margins. This mega project is managed by the state-owned China Rail Corporation. Now, in the past few years, mega loans were made by provincial governments to monetize their high-speed rail lines, and this has created a debt trap which is now, in turn, straining the holding company. The CRC's financial problems began nearly 4 years earlier when more than 60% of the high-speed rail operators lost at least $100 million each in 2018 alone. Chengdu's least profitable operator reported a net loss of $1.8 billion that year as well. Now, at the same time, Chinese transport economists predicted an impending debt crisis for the country's high-speed rail system, which was reliant on unsustainable government subsidies, with many lines unable to repay even the interest on their debt, let alone the principal. Everyone was caught up in a vicious cycle of raising new debt to pay up old debt. Consequently, since 2015, the CRC's interest payments have been significantly higher than their operating profits, shrinking its bottom line. The nail in the coffin came in March of 2021, when China's State Council, the highest body of state power, issued a red alert, ordering a reduction in high-speed rail investments to avoid a growing debt trap. The new restrictions have put a halt to the development of new high-speed rail corridors, especially on underutilized routes. For a country that saw a 91% increase in the number of new rail lines from 2015 to 2021, the new standards indicate that China's quest for speed hasn't come without its fair share of collateral damage. China is looking at a ballpark on-paper debt figure of over $850 officially from this industry alone. In the past 2 years, the pandemic hasn't made it any easier for the industry either. As people sat at home, the demand for high-speed rail plummeted. For the first half of 2021, even though the demand for rail travel was back to pre-pandemic levels, the industry reported a net loss of $8 billion. Moreover, these numbers understate the actual levels of debt that the railway industry in China carries today. Roughly half of the costs associated with constructing railways are borne by local governments, so it follows that the total level of railway debt is touted to be somewhere close to $2 trillion. Now, some finance wizards at Goldman Sachs claim that the local governments of China are in serious trouble as they need to repay north of $8 trillion in total, an amount which is half of the country's GDP. China is currently stuck in limbo, where the government needs more and more infrastructure projects to grow their GDP numbers, but the more railway lines they build, the more money they continue to lose. A country that's been burning hundreds of billions of dollars every year on rail for over a decade needs to reassess its priorities at a time when basic needs like education, clean water, and poverty are being compromised. Now, in an economy, there are usually considered to be two types of growth: cyclical and secular. Now, a cyclical market is shorter in duration and typically exhibits seasonal or cyclical business conditions where the market sees peak, trough, and peak again movements. Cyclical stocks tend to move with macroeconomic conditions like economic growth as a result of infrastructure spending, which China is witnessing today, where the government creates growth by undertaking large projects and it's typically fueled by enormous levels of debt. Cyclical growth has its benefits in the short term, where it can create a positive spike in GDP, but it tends to die down eventually, and once that growth wanes, cyclical stocks are typically sold off. On the other hand, though, a secular market is driven by long-term events with persistent conditions regardless of economic slowdowns and cycles. A reality that is supported by a foundation of ethical capitalism. This is possible where a conducive environment exists where entrepreneurship can flourish and companies are created which provide value to society. Xi Jinping's government clearly understands that the economy needs to transition to the latter, which is why we're seeing some policy amendments to slow down credit like the Three Red Lines policy, the rules of which mean that giants like Evergrande, Fantasia, and China Property Group are on their knees today. However, China being China, Beijing is aggressively chasing down the technology sector since the suppression of Ant Group's IPO in November. Internet conglomerate Tencent, food delivery app Meituan, e-commerce company Pinduoduo, ride-hailing app Didi, logistics company Full Truck Alliance, and a crackdown on cryptocurrencies are among the companies and assets that have suffered excessive amounts. On the surface, China's tech crackdown appears to be just that, a confrontation between government power wielded by the CCP and the tech sector, as many refer to it. The truth is a little bit more complicated. Even if there is a method to the madness, the agencies participating are diverse, the industries targeted are diverse, and the justifications are diverse as well. It is a collection of numerous issues rolled up into one. What's going on has been divided into 7 categories but can be simplified into 3 main segments, which are number 1, antitrust enforcement, number 2, data security reform, and number 3, a tab on capitalist excess. Antitrust investigations had been conducted primarily by the State Administration of Market Regulation, SAMR, China's market watchdog, on at least 35 internet companies spanning a wide range of industries, with some of them already being punished. So who's facing the music? Well, Alibaba was fined a record $2.8 billion. It became the first and largest victim of China's antitrust investigation. Regulators summoned 34 IT companies just 3 days later to check compliances on antitrust violations. Secondly, the Cyberspace Administration of China, CAC, established in 2014, who is in charge of data security, wherein it holds the reins of China's massive censorship apparatus, as well as guaranteeing that private enterprises' data on Chinese residents do not leave the country. The app for hailing a cab, Didi, was the most visible casualty of this data security crackdown so far. Didi's app was suspended by the CAC 2 days after the company's IPO in the United States for breaking data security regulations. It then expanded the investigation and app freezes to include 2 more Chinese businesses listed on the New York Stock Exchange, freight logistics app Full Truck Alliance and hiring platform Kanzhun. Tesla, on the other hand, has been another early guinea pig for China's data security policies. Tesla cars were banned from China's military in March, and after meeting with cyberspace regulators, the firm declared it would store data domestically. Personal data being exposed to foreign foes is a concern for China's regulators. Aside from the broad concern that the US would gain control over Chinese companies listed in the US, it's difficult to say what about the IPO process irks them, and there's a good chance that an awful lot of this amounts to nothing more than a petulant child throwing their toys out of the pram. It sure seems like the message being sent to Chinese companies at this point is, you can go overseas, but you need to get your home in order first, and your home will always remain your home. Now thirdly, China's senior leaders pledged to halt disorderly capital expansion during a summit in late 2020. What is understood as growing at the expense of the public interest, the catch-all phrase may help explain the government's actions on establishments and their arbitrary bans on for-profit tutoring. The Ant Group IPO suspension was probably the most high-profile example of this apparent assault on the public interest. Nonetheless, this is not the first time, and the casualties date back far further. In 2018, China took a hard line against its gaming juggernauts Tencent and NetEase, delaying new company approvals and imposing severe gaming curfews for minors. This was ostensibly done in reaction to public uproar over gaming addiction. Most recently, China's major education enterprises, New Oriental Education, Tao Education Group, and Gaotu have seen their stock prices plummet since the for-profit tutoring ban took effect. Despite the fact that these companies were increasing the levels of education in the country, they were providing a public service and they were creating wealth at the same time. But for some reason, the CCP decided that it was not to be allowed. We are living in a world of 2 hegemons, one in the East and one in the West, but there is a significant distinction between the Chinese and American markets. What the tech crackdown reveals is that China is considerably more willing to compromise investor interests to achieve state aims. Whether on a surface level or in substance, only time will tell. The reality before us today is that according to the latest regulatory crackdowns, around $400 billion worth of investor value in Chinese companies listed in the United States alone has been wiped off. And a hefty amount of that wealth that has disappeared had been in the hands of Western investors. When Western markets show that amount of risk, as they did in 2008, it is frequently seen as a setback rather than a policy victory. Now, there's little to be said about a nation with a loose foundation. On the outside, it may look like because everything is managed and decided by the government, the systems function like clockwork, but the truth is unfathomably ugly. Place yourself in the shoes of the average Chinese citizen for a moment. You're living in constant fear of the government's diktat. The success of most of the investments you're about to make or have made is subject to the whims of Z. The success of most of the investments you're about to make or have made is subject to the whims of Xi and how he's feeling on any random day. Because of the weird residential policies, you're ineligible for affordable housing and public transport. Your job is under constant threat because companies are going bankrupt. The country is running out of fresh water to drink because of years of unsustainable manufacturing practices that have led to severe contamination of major water bodies. Even manufacturing has started to crumble as the country witnesses serious electricity issues and creditors are showing signs of distress. Day in and day out, the authoritarian government fakes news and inflates economic progress to keep blinders on the people and keep them artificially satisfied. You have capitalists like Jack Ma encouraging the working class of the country to work from 9 a.m. to 9 p.m. 6 days a week like cattle. This is real. Southeast Asian countries and especially China are guilty of overworking employees to their tipping point to compete in the already compressed labor market of the world. The average Chinese citizen is exhausted to say the least. For the past 2 years, the world has put China in a rough spot for the pandemic as well. We can only speculate on how things went down in Wuhan, but today, the general public of China bears the brunt of the pandemic. The debt bubble will lead to the collapse of giant real estate firms like Evergrande, terrible government practices and corruption in sectors like public transport, and bullion conglomerates that provide real jobs, income, and value to the ecosystem are only leading to compounded resentment in the economy. It seems like China will be the perpetrator of another global pandemic, a global financial pandemic. The entire world will be financially sick once China is done dusting its hands. Now, I'm currently sitting in my comfortable home in the UK. I have nothing to do with China, but I promise you that when China falls, everybody around the world will feel the tremors. It will just take one whiff of reality to eventually bring down this Chinese house of cards. Finally, I want to give the Daily Upside one more thank you for partnering with me on this video. If you haven't subscribed already, click the link in the bio to receive their weekday and weekend edition absolutely free. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting at all, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.